bears, bulls, and a lot of potential room to supplement your income. The stock market can either be a blessing or a curse on your bank account. Following the tip in number 1 could make you a millionaire. Here are 7 things you need to know about the stock market. Number 7. Know all your options. A lot of people get into the stock market looking to increase the worth of their savings. And this makes a lot of sense. With the current interest rates on most savings accounts, and when factoring in steady inflation of modern currency, there's a good chance that leaving your earnings in a bank for 10 or more years may actually cause you to lose money. That said, while you can certainly make a lot of money in stock, you should know that there are a lot of other options too. Real estate investing might be easier than you think. Gold is almost always increasing in price if you hold on to it long enough. And angel sites on the internet, the act of loaning money to other people, can also be a great investment. That is called peer-to-peer lending, and there are actually a good number of websites that deal with that you can check out. Stocks are great for some people and not so good for others, but no matter what you choose to invest in, the reality is you should do as much research as you can. Who knows, with enough study, you might even be the first millionaire in your neighborhood. Number 6. Risk versus reward. The 2 most important principles when investing in stock that you really need to get familiar with are risk and reward. Generally, the higher the risk in investment, the higher the potential reward that's also available. A good example of high risk and high reward is that either the companies are either on the decline or they're in the startup business. Depending on what's going on within these types of companies, you may be able to find their stock for relatively cheap. However, in either of those situations, you'd stand to lose a lot of capital if you're wrong about their potential to either succeed or come back from disaster. Even with the risk though, there are certain types of investors that are known for taking these exact calculated risks. It's not uncommon for even your average but still somewhat experienced investor to buy up the stock of a company that looks like it's going to make a rebound. Angel investors and venture capitalists make a living by investing in startup companies. That said, these 2 types of investors often have a sizable fortune to fall back on and can afford to take a few risks in their stock picks. Not to say that venture capitalists don't have a lot to gain if they're smart about their investments. Jim Breyer made a lot of money investing in a young Facebook. And Peter Fenton did the same with startup Twitter. Before buying a stock, you should always weigh the risks versus the reward that's associated with it. Remember that, and you should be golden. Number 5. The state of the market. Bull markets? Bear markets? What does it all mean? Well, don't worry. You're not going to see a grizzly or a bull driving away or goring investors or their money on Wall Street. A bull market is just a term that's used to describe a stock or industry, maybe even an entire economy, that's rising in price and earning potential. A bear market, on the other hand, just means that a few stocks, or the market as a whole, is stagnant or losing in value. Where did these names come from, though? They do seem a bit random and off the wall, don't they? Well, a long time ago, bear and bullfighting was actually pretty popular, so the 2 animals were seen as opposites by society at large. This, of course, was before all of the animal cruelty laws of today. Bears were known for attacking their prey by swiping their claws down, and bulls were known for thrusting their horns up into the air when attempting to gouge something. Thus, a market that's going straight into the dirt is known as a bear market, and one that's being tossed right up into the air is known as a bull market. There are lots of opportunities in both good and bad markets, if one knows where to look. Warren Buffett, John Paulson, and Jamie Dimon all made a pretty penny during the economic recession of 2008. Many an investor will advise you to buy when there's blood on the streets. Ouch, that's merciless investing for you. Number 4. Vultures too? The stock market is more than a place where you can invest money in a company to make money. The overall stock market is the heartbeat of the economy, and individual stocks are the pulse of the companies. Many people think that only a company with a strong pulse is worth looking at, but this isn't always true. There are even some investors who don't look for companies that are succeeding at all, but in fact those are actually in debt. Investors that actively look for sick and dying companies are often referred to as vulture investors. They look for stocks that are selling for under fair value, and then these opportunists buy the debt of the failing companies. Sometimes vulture investors are actually banking on a company being saved at the last minute by a merger or restructuring, but they're also known for scooping up the land, equipment, and other assets of crashing businesses. Now you know why they're called vultures. Picking away at the pieces of a company can give you a ruthless reputation, but these types of investors can also line pockets. Of course, vulture investing is by nature risky, but it's also free of many of the other risks of normal investing as well. It's also a perfect example that you can make money by not doing what everyone else in the market's doing, in this case by not buying stocks, but by preying on them instead. Vulture investors invest in debt and pluck away at assets, but you can also invest in a lot of other things that aren't stocks too, like bonds for example. Being smart and thinking outside the box may very well be the way that you become a very rich person. Remember, ingenuity is often rewarded by the world when it is mixed with purposeful patience and tempered by measured intelligence. Number 3. Don't just invest in one company. Have you ever heard the expression, don't put all of your eggs in one basket? Well, sometimes that saying is true and sometimes it's not. In the case of stocks, though, it usually is true. Having a diversified stock portfolio means investing in a large number of stocks, but not investing too much money in a single one. A good rule is to not invest a high percentage of your money in any one stock or any one type of stock. You should also avoid just dumping all of your money in one sector or industry, such as all tech or all utilities, at least in the beginning of your investing journey. It is, however, a good idea to have your money stored away in stocks and assets that all do differently in different markets. A smart investor will likely have assets that thrive well in a bull, a bear, and even a sideways market. A diversified portfolio will be your base for your investments. It's generally best for you to invest in a low-risk and slow-return stock and asset at first, unless you're willing to really manage your money and assets actively. If you're smart and invest a good amount of money in a safe and well put together portfolio, you might be able to live off the money that you make. Or you can invest your profits from your stock earnings into higher risk assets and roll the dice. Hopefully though, you weigh the dice in your favor by following all of the tips. Number 2, have a plan for balancing your portfolio. If you took our advice and invested in a diversified portfolio, then great. You're well on your way to success if you keep your head and your wits about you. Just remember, every once in a while, certain stocks may start weighing your investments down. It's never a good idea to panic and sell your stocks for less than you paid for them, but if a certain company or industry is consistently underperforming, then there may be times when you need to evaluate a portion of your investments in those stocks. We warned against making spur-of-the-moment decisions in investing, so to avoid that, it's great to have a plan in place for exactly how you're going to go about making critical decisions before you make them. Just remember to make these plans when the market's doing well and not to wait until it's starting to take a dive. He who prepares is often he who succeeds after all. Number 1. Understand what the stock market really is. Perhaps the simplest and most basic tip, this is also probably one of the most important that you can follow. The reason that it's so hard to predict the movements of the market is simple. People's emotions can affect the stock market pretty drastically. We've all heard about the Great Depression, where scared stock investors blew the economy to high heaven for years. What actually caused the crash of 1929 was the fact that Wall Street had been overvaluing stock for a long time before that. Everyone had just gotten swept away by their emotions and optimism, but the second they started to realize the half-glass-full attitudes had overinflated the market, well, then all hell broke loose and everyone started to panic. Millions of dollars were traded on Black Tuesday by worried investors. That's the day that would cause the market crash, ushering in the Depression. At the end of the day, stocks aren't all mathematics, numbers, and complicated formulas, although it's true that these things can help to predict the ups and downs of the market. In reality, when you buy a stock, you're investing in a company that's run by people. People who are relying on you and other investors to give them the money they need to run their company. Really, people are the stock market. Even though it's easy to forget that with all the numbers and graphs floating around, just remember to think with your head and to understand the people in the market with your heart. And as Warren Buffett once said, be fearful when others are greedy, and be greedy when others are fearful. Don't forget to subscribe below. Thanks for watching, and we'll see you next time.